one. There I am. I decided to have a cup of coffee with y'all. My Liberty mug. Might get distracted by my wife because she's floating around in the background. Here we go. Good morning, good morning, good morning, and welcome everybody to the Real Estate Connection, hosted by your host, Stephen Thayard, Realtor with Coldwell Banker, out of KFAX 1100, San Francisco, Oakland, San Jose, and for my South County friends, Morgan Hill, San Martin, and Gilroy. Woo! Welcome to the show. Hey, you know what? Times have changed so quickly in the last 7 days since the last time we got together. And it's amazing the technology that we have in order to keep things moving forward. I am actually broadcasting out of my home today through the radio station phone lines because in Santa Clara County and San Mateo County and Alameda County, we have been required to shelter in place. But as they say, the show must go on. So thank you for joining me this morning at 8 a.m. as we talk about all things real estate in the Bay Area. And today's topic is the Fed lowers the short-term borrowing rate and its effect on mortgage rates and how to defer. Well, I'm sorry, I was going to actually add that to the show, how to defer a mortgage payment in case you're getting in trouble from people having to be sidelined from business. But I took that out of this week's show, and I'm going to wait and see how long this actual coronavirus issue lasts before I broadcast that. So today's show is Fed lowers rate and how bonds affect mortgage interest rates. A lot of people think that just because the Fed lowers the rate that it automatically affects mortgage interest rates. However, that's not true. And so I've been told that many times by my lender friends. So on today's show, we're going to walk through why there is not a direct one-on-one correlation. But we are going to talk about the Fed lowering the rate and an email that I received from one of my close, good mortgage lender friends and him walking me through and now you guys through how that's affecting the market. So we're all enjoying our sheltering in place. If you're in Alameda, Contra Costa, Marin, San Mateo, or Santa Clara counties, and can you believe it's been 1 week of business and like life has come to a complete halt for a lot of different people. Life as we know it has changed. Restaurants are serving only to go orders, bars have closed, and kids are home from school. And I've read recently that our illustrious governor thinks that we may not have schools go back into session for the rest of this year at all. I think he's calling that a little too soon. I think the federal government needs to act and see how we're going to be doing with not only virus vaccines, but the actual spread of the virus and whether or not we're going to plateau on our curve. We also have a new term that we haven't used before called a social distancing. I have one question for you parents. How do you keep your kids 6 feet apart? Just saying. Because I'm at home doing my social distance thing, and the kids are in the front yard having a grand old time riding their bikes up and down the streets, playing in close proximity to each other. So, and if you haven't seen it, there's lots of videos on the internet throughout the various platforms of our youth out there celebrating spring break on the beaches of Texas and Florida. So they're not really practicing that social distancing as well. So you have to forgive me. My producer, Marco, is not in front of me, so I can see him tell me what the countdowns are. So you may hear me pause from time to time to listen to him to tell me when we're coming up on a commercial break. But anyway, in keeping with the spirit of St. Patrick, here is another blessing related to helping one another in our time of crisis. If either of them falls down, one can help the other up. But pity anyone who falls and has no one to help them up. And that comes from Ecclesiastes 4:10, the NIV version. Basically, what that is saying is all of us need to work together during this time to help each other up. Let not your labor feel like they are alone. And if you know of people that are shut in or by themselves, reach out via phone, ask if they need help, especially if you know elderly people who have immune system issues, who can't go out and shop and who are afraid to go out and shop. Maybe offer to go buy them groceries. Okay, so that's it for the blessing. So, in keeping with the theme of blessings, I would like to bless you with information on what the Fed cut means and mortgage rates and how bonds affect interest rates. But before we get started, I would like to throw out my obligatory offer. If you email me for a no obligation appointment to give you an estimate on the value of your home, or just I would sit down to discuss with you the prospect of buying a home, but in these times, let's make it a phone call. I have a gift for you, which I can drop in the mail. We do not need to hand this book over to you in person. I'd like to give you a copy of a book called The Family Preparedness Buyer's Guide. Now, a lot of people kind of looked down on preparing maybe as heavily as other people's have done in the past in regards to being ready for a break in the normalcy of life. And this book provides guidance for that. So if you have a copy of this book, or if you've listened to a few of my shows in the past and followed some of my advice as far as getting ready for unnatural disaster or an event, you probably have already been prepared. But if you were caught without being prepared, this is a book that will help you in the future. This is a must have book for families preparing for any emergency, including the Wuhan virus or COVID 19. And this bestseller will provide you and your family with information on the best survival gear, tools, and weapons for your skills and budget. Chapters include emergency shelter, fire and clothing, emergency food and cooking gear, emergency communication and navigation, and survival weapons. I have a copy of this book, and it's a very easy read with lots of useful information. So, again, if you reach out to me at info@realestateconnectionradio.com and send me your contact information, I'd be happy to reach out to you to get you this book if you want to talk about buying a home or getting your home sold in the near future. So, let's get down to business. Marco just said 2 minutes in my ear. I heard that. Good job, Marco. Good job. Thank you. What does the Federal Reserve rate cut on Sunday, March 15th really mean for mortgage interest rates? I have been told, like I said in my opening, many times by my lender friends that the Federal Reserve rate does not directly affect mortgage rates. In that regard, I received an email from a prior guest on this show, Mike Gallagher, Senior Mortgage Advisor with Finance of America Mortgage, regarding how it affects our mortgage market. So when we get back from the break, I'm going to dig into his email and read it to you so you have a better understanding of what's going on if you're thinking about refinancing due to the lower interest rates or getting off the fence to purchase a home amidst this coronavirus scare. So when we get back from, what was that, Marco? How much time do I have left? 1 minute. All right, so I'm jumping the gun. So let's dig into it a little bit. All right, so I'm going to read through the email. The Federal Reserve did announce a significant emergency rate cut on Sunday. Contrary to what many believe, this does not translate to lower mortgage interest rates. The rate the Fed cuts, the Fed funds rate is the rate charged for every short-term borrowing between banks and the Federal Reserve and between banks. It is meant as an adrenaline shot to the economy to try to stimulate short-term borrowing for business. When we get back from paying some bills, we're going to get into this in more detail, so I'll see you in a minute. Okay, folks, I hope you're enjoying the show. I'm having a cup of coffee in the middle of the day. Man, has the world changed Fed lowers rates, how bonds affect mortgage interest rates. That's what we're talking about today. Share the show out with your friends. If you're sheltering in place, it's lunchtime anyway, you take a break from work, sit down, have a cup of coffee with me, and figure out and find out how bonds affect mortgage interest rates as well. It's a good lesson to learn so that you can interpret news from a more informed perspective as you move forward in life, especially if you're a homeowner or you're a potential new home buyer. All right, Marco, I'm going to let you spin me back up as we move forward in today's show. Hey, everybody, welcome back to the show. Welcome back to our shelter in place real estate show. I know, it's a bad joke. It's a bad joke. A lot of us are feeling the effects of the shelter in place in Northern California, and Northern California real estate is experiencing the shelter in place. And if time permits in this show, I'll dig into that a little bit as it practically affects people who are in the middle of a sales transaction or who have their properties listed for sale or who are out there hunting for real estate right now based on the order that was given by the health department for us to follow all the way up into April 6th, April 7th of 2020. But before we left for the break, we were talking about how the Fed has recently lowered its rate to the zeros. So it's 0.25%, I believe. So it's down under 1 percentage point. And an email that I received from a good friend of mine, Mike Gallagher, who is a senior mortgage advisor, explaining how the Fed cutting rates does not specifically translate to a reduction in mortgage rates. And so I thought it would be a good idea to read his email on the show to educate all of us on how, when the Fed lowers rates, how it really affects mortgages and what's going on in the mortgage market. So, his email reads as follows. The Federal Reserve did announce a significant emergency rate cut on Sunday. That was on, I believe, March 17th. I'm sorry, March 15th. Um, Contrary to what many believe, this does not translate to lower mortgage interest rates. So I hear a lot of people talking about, oh, the Fed cut the rate, mortgage rates are going to drop. That's not necessarily true. The rate the Fed's the Fed cuts, the Fed funds rate is the rate charged for every short-term borrowing between banks and the Federal Reserve and between banks. So the banks borrow money from the Fed and the banks borrow money between each other. So it is meant as an adrenaline shot to the economy to try to stimulate short-term borrowing for businesses and is in response to the significant sell off in the stock market. So, what that's doing is it's allowing banks to loan each other money for almost nothing, which helps money get infused into the market and hopefully keep the market going as we're seeing a reduction in people being able to get out into the marketplace and spend money and help the economy keep going. So his email goes on to say, that said, and what has been lost in the reporting is that the Fed has pledged to invest $700 billion dollars into the bond market, okay? Mixed between treasuries and mortgage backed securities. This was the news that the housing market should be focused on. In theory, as the Fed acts as a buyer of mortgage backed securities, it should drive mortgage rates down. And he goes on to emphasize should drive rates down. Won't necessarily do it, but in theory, it should drive rates down when the Fed starts buying uh, 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 $7 million, 700 billion into the bond market. All right. So, so he says, I say should as there is no guarantee. The Fed purchasing will be enough to soak up the sell off of bonds, right? So Bonds are getting sold off, and he's saying that the 700 billion may not be enough to soak up the sell-off. It really pales in comparison to the roughly 5 trillion with a T in existing loans in the US that are potentially eligible for a refinance. So this is one of those time will tell actions, but there is hope. So we're hoping that the Fed buying $700 billion of bonds that are maybe being sold off will prop up the bond market. All right. So his next bullet point. Important also to understand, with the flood of refinance activity in the past 2 weeks, many lenders are at capacity and are therefore slowing the intake of new loans by artificially increasing rates. He says, I'm already getting those calls from new clients wondering why lender X or lender Y is quoting 4.25% today. The reason is they're at capacity, and raising rates is how they slow the volume. So, because so many people have rushed in to refinance, lenders are full. They can't take any more work. In order to slow down the amount of new applications coming in to refinance homes, they're artificially increasing rates to slow people down from coming in to refinance. And that's very interesting. So if you got in early, right, you took advantage of the rates. But if you were late to the game, you might be seeing rates gradually rise and it will slow you down from refinancing because it doesn't make any sense, right? If you have a rate at 4.5% and the rates have come up now to 4.25%, it's not worth your time and money and effort to refinance for just a quarter of a percentage point, right? So hold on tight. There's more to come. He says, we are happy to take those clients not getting the quotes they believe they deserve. So further on in my notes, I will provide Mike Gallagher's phone number. As a matter of fact, let's do that right now. So he's saying that they can still take your applications. His mortgage, his company that he works for. His phone number is 408 930 6064. Again, 408 930 6064. He's indicating to me in this email that they still have capacity to take your applications, which means I'm assuming, and you'll have to verify when you call him, that his company isn't artificially increasing rates to slow down people making applications. He says, you will also see smaller lenders run into funding issues in the coming weeks/months. As their loan volume grows, some may run into liquidity issues and might delay funding. So be cautious when accepting offers, realtors, when know who your buyer's lender is. So this also is for people who are out there searching for homes now. My advice is to go back to your lender today and ask them if there will be issues with funding your loan on time, if there will be issues with processing your loan. A lot of lenders, from my experience, are doing both types of loans in the market. They're doing purchase money loans for buyers who are purchasing homes, and they're doing refinances. And their underwriters are working at both at the same time. So you have a stack of loan applications coming in that are commingled between refinances and purchase money loans for new homes. If you have a hiccup at all in your financing process where you're missing documentation and the underwriter calls something out, they're going to take you out of the top of the list and set you on the side. Now, if they're doing both purchase money loans and refinances, you may be at the bottom of a very lengthy wait list where you have to come back up through the top of both. If you have a lender that focuses primarily on purchase money and not refinances, it may not take as long for them to pick your file back up to look at the document that they've requested so they can go ahead and tick off the last box and give you final loan approval. So if you're working to do a purchase or a refinance, know what your primary function of your lender is. And if they have separate departments working on lending versus refis, because if you're in a lender who does both and you're co-mingled together, that could delay the time it takes for you to get final loan approval on your loan. So ask the question if you're out there in the market right now working on stuff. Okay, so Mike goes on to what are we advising clients to do? So Marco said I had a minute, which really means I have 30 seconds. So when we get back from the break, we're going to continue on going into Mike Gallagher's email that he sent to me, that which I'm sharing with you in regards to how the Fed lowering the rate, which and really what's really important is them buying bonds, affects mortgage interest rates and what's going on in the lending environment with so many people rushing to refinance. So stay with me, and we'll see you at the end of the commercial break. All right, we're rocking and rolling through this thing. In case you didn't know, I'm working out of my home office today. I'm not in the studio. That's why you don't see the boom mic sitting in front of my face. I'm actually on my headset. Where is it? Right here. I'm on my headset with my producer. I've got too many cords around my neck this morning or midday. And we're going through the show, recording it remotely because I am sheltering in place. How about you guys? Are you sheltering in place as well? Are you enjoying working from home? Do you have kids running around driving you crazy? And with the governor saying that schools are not going to reopen again this year? That's nuts. That's nuts. I can't believe how quickly the world has changed in just a week. Anyway, I digress. We are going to jump back into what? Long segment number three? All right, long segment number three, which means two more long segments. Thank you for joining me this morning, all y'all that are watching me live. I appreciate the support. Share the show, share the show, share the show. I appreciate it, appreciate it, appreciate it. Blessings to you all. All right, Marco, I'm ready for the music. That's the background music playing. Hey, everybody, welcome back to the show. Today we are discussing the Fed lowering rates and how bonds affect mortgage interest rates. I received an email from a good friend of mine, Mike Gallagher, who is a senior mortgage advisor, and he really walked through this thing in detail. So I thought I would share it with you. I've been told many, many times by my friends at Guaranteed Rate Affinity in my office that the Fed lowering rates does not have a one-to-one direct correlation on mortgage interest rates. Okay, and so I wanted to explain to you why that is true. This email from Mike Gallagher explained it to me, and also laid out the real story was the Fed buying back $700 billion of bonds and investing it into the bond market because of a sell off. So he was giving advice in regards to being careful with your lender and knowing whether or not, with these issues coming in with so many people refinancing and coming into the table with low interest rates, if you're going to have a problem closing your deal on purchasing a house on time with funding and or being able to process your loan due to the fact that your lender may be doing both types of business, lending and doing refinances, and if there maybe are a smaller lending institution, if they're going to have liquidity problems as far as being able to fund your loans. So that's not to say that they can't, and I'm not bashing anybody. The advice is to just check with your lender to see how they're holding up in this mad dash of refis and people out in the market buying properties, to see if there's going to be any delays in your particular situation, especially if you need to pull cash out to pay bills or to buy a home. So we were reading through this email, and he was saying what he is advising, what is his advice for his personal clients. So he says, for those in a position to purchase, this is an incredible time to lock in an unbelievable rate for a purchase mortgage. If you are confident in your employment, there there really is nothing to fear. So what he's basically saying, so if you're an essential service person, right, and you are working, maybe you're supplying the food for the nation, or you're in police, fire, or infrastructure, or you're in the healthcare industry and you're working like a dog right now, you've got really stable employment. A lot of people don't, but this may be an opportunity for you to get out to the market and take advantage of the lower interest rates, because you really don't have that much to fear. For those with a rate of 3.875% or more, now is the time to get ready to refinance. As the coming days and weeks unfold between the effects of the coronavirus and the Fed's mortgage-backed securities purchase activity, we are likely to see another significant drop in rates. So for those that didn't catch the break a couple of weeks ago, there will be another opportunity. So there's the hope, folks. We just spoke about the fact that lenders are at capacity and they may be artificially increasing their mortgage rates to slow down applications because they just can't handle the volume right now. There will be a second round, he's saying, coming up in the future. So if you want to take advantage of this, the idea is to get ready for it now. He's saying we are encouraging clients to get their financial information into us so that we are in position to lock during the next drop. And if you were ever considering cash out to consolidate debt or home improvement, now is the time. So my advice and his advice are basically the same. If you miss the first significant drop in rates and you're seeing them tick back up because of the volatility in the market and because lenders are at capacity, get ready and be prepared for the next drop that he says will probably come in the near future within the next few weeks or months. So gather your documents together, make your phone calls to your lenders that you're working with, ask them where they are at in their cycle, whether or not they're at capacity, whether or not they're seeing delays, whether or not they're having issues with liquidity. The other issue that we're seeing out there is time it takes for appraisals to get done, because refinances require appraisals as well. And we have not increased the number of appraisers in the market doing appraisals, and they are buried. So it's taking a little bit more time. However, know that for the order, based on what I've seen coming out from the health department and the county, is that banks and lending institutions are considered essential services. So therefore, we are still able to move forward your purchase if you already are in contract or if you're already in a refinance. The banking system has to keep moving forward even in this shelter in place order. So that's good news. So for those who would like to contact Mike Gallagher in regards to refinancing a home or getting pre-approved for a purchase, he can be reached at 408-930-6064. Again, that's 408-930-6064. If you missed the phone number, you can contact me directly at info@realestateconnectionradio.com. Again, that's info@realestateconnectionradio.com. Now, let's shift gears from how the Fed has affected rates now and their buying back of mortgage based securities to the tune of, and I'm flipping back in my notes here, $700 billion in a $5 trillion marketplace, and talk about how mortgage rates are really affected. Okay, it's good for all of you to know how it really works so that when you hear information in the news cycle, it will perk up your ears, raise your antenna as to whether or not it's going to affect mortgage interest rates before the news actually reports it. So you're going to get financial data or information in emails, or if you follow the markets online in internet searches, you'll see things that should clue you in based on the information I'm going to provide, that will let you know that mortgage rates should be dropping based on information that you're receiving. So I'm going to walk through an article written by Kimberly Amadeo of thebalance.com. And the title of the article is How Bonds Affect Mortgage Interest Rates. Pretty self explanatory, right? So Kimberly starts right out of the gate with this simple statement: bonds affect mortgage interest rates because they compete for the same type of investors. They are both attractive to buyers who want a fixed and stable return in exchange for low risk. Okay, Marco, how much time did you say I have left? Got a minute and 10 seconds. So, what we're talking about now is how are mortgage interest rates, what really affects mortgage interest rates. And what really affects mortgage interest rates is bonds. It's the bond market. So bonds affect mortgage interest rates because they compete for the same type of investors. They are both attractive to buyers who want a fixed and stable return in exchange for low risk. All right, she goes on to explain why bonds are such a low risk. First, they're loans to large organizations such as cities, companies, and countries. They are more likely to pay back loans than individuals. So when you're getting a loan from a very large corporation that has strength and stability, there's a high likelihood that they're going to repay. So when we get back from the break, we're going to get into more detail as to how bonds affect mortgage interest rates and how you can listen for information out there in the financial news that will let you know whether mortgage rates will be dropping or going up as you're paying attention to what's going on in the market. And we'll see you when we get back from the break. All right, so stay with me. This is important. What really affects mortgage interest rates for your mortgages are bonds. Not the Fed lowering the rate, but bonds. Okay, so we're walking through right now how the bond market affects mortgage interest rates. And we're going to step it through so you guys can have a better understanding of how that all works. And I personally need to have a better understanding of how that all works. I've fallen into that trap of hearing that the Fed has lowered rates and automatically thinking that mortgage interest rates were going to drop. So let's go back through it for 1 second. Bonds affect mortgage interest rates because they compete for the same type of investors. Okay, they're competing for the same type of investors. So Marco, I think we're ready to spin this thing back up. Hey everybody, welcome back to the show. This is our last segment, and what we're walking through right now is how bonds affect mortgage interest rates. Not the Fed lowering rates, but the bonds and the bond market. I'm going through an article written by Kimberly Amadeo of thebalance.com. The article was written on February 10th, 2020. The title of the article is How Bonds Affect Mortgage Interest Rates. Pretty self-explanatory. Before we went back from the break, I was reading through a simple statement that she made in the very beginning of her article, which reads, Bonds affect mortgage interest rates because they compete for the same type of investor. They are they are both attractive to buyers who want a fixed and stable return in exchange for low risk. She goes on to explain why bonds are such a low risk. First, they're loans to large organizations such as cities, companies, and countries. They are more likely to pay back loans than individuals. Okay, the second reason why bonds are low risk, and I quote from her article, second, bond rating agencies study each company and bond. They report on the safety of these products. This gives investors a good reason to believe a specific bond is a low risk. Third, the third reason why bonds are low risk, and I quote again from her article, third, bonds can be resold on a public market. They're securities that are easy to trade, so an investor doesn't have to keep the bond through the life of the loan. And I quote her again, different types of bonds carry different risk levels. Bond investors are looking for predictable outcomes, but some are willing to take on higher risk to get a better return. The last quote is the keystone. The safest bonds include most municipal bonds and U.S. government Treasury Notes. Okay, so when you're getting investment advice from a lot of people, you'll hear that if you want to be safe, go into bonds versus stocks. This is why. All of this is laid out to you based on what she's quoting in her article. Is that bonds have a low risk because you tend to borrow the money and get paid back from very large secure entities, either cities, companies, or countries. There are bond rating agencies out there that tell you whether the bond is a high or a low risk as well, and you can resell them on the market in the marketplace without having to hold them all the way to maturity. It's also written here in this article that two of the safest bonds out there include municipal bonds and US government Treasury notes. That's tied to the US government. So, Treasury notes have the biggest impact on mortgage interest rates, okay? Treasury notes. So if you follow the Treasury note rate, you should be able to follow mortgage interest rates. Her article quotes the following: US Treasury notes offer similar term lengths at 10, 20, and 30 years, but are ultra safe due to their government backing. As a result, investors don't require high rates, meaning they're so safe that the investor doesn't want a higher rate of return because they know that they're pretty much going to get their money paid back to them. Okay, so this is another key as to why the Treasury note is important in regards to mortgage interest rates. She quotes, banks keep interest rates on mortgages only a few points higher than Treasury notes. So there's the tie in. Banks' mortgage rates tied to US Treasury note rates. The banks keep their rates a little bit higher than Treasury notes. Those few points of higher return are enough to push many investors towards mortgages. There you go. So if you follow the T-bill rate, you'll pretty much know what's going on with the mortgage interest rates. So she goes on to quote, Treasury yields only affect fixed rate mortgages. The 10-year note affects 15-year conventional loans, while the 30-year bond affects 30-year loans. So if you're looking at a 15-year conventional interest rate, you'll look at the 10-year Treasury note, And if you're looking at a 30-year mortgage interest rate, you're going to be looking at the 30-year Treasury note. When Treasury rates rise, so do rates on these mortgages. So the $1 million question is, what causes Treasury note yields to rise and fall, right? So if you really want to get into the analysis of what's going on, besides just watching the T-bill rate go up and down to try to track where mortgages are, you can start looking at what factors are out there that cause the T-bill rate to go up or down. So I got curious about this, and so I went looking to get an answer for this question and searched the internet, and I landed on the Federal Reserve Bank of San Francisco's website. The following are some factors affecting the Treasury note rates, and I'm going to read what I pulled down off of their site. Many factors may affect Treasury bill interest rates in general, as well as rates for specific issues of Treasury securities in particular. Here are several factors that you might want to consider. Again, I pulled this information directly from the Federal Reserve Bank of San Francisco's website, and I'm quoting from that information, which is open to the public for everyone to read. So you can go out there and check this information for yourself. Okay, the first bullet point they start off with is demand. Demand for risk-free fixed income securities in general. For example, a flight to safety caused by concerns about default or liquidity risk in other financial markets may cause investors to shift to treasury bills to avoid risk. So when you're seeing volatility in the stock market and people are concerned about losing their money quickly overnight in stocks or funds, maybe stock funds, they'll shift into a safer place to invest. And the safest, as we've quoted, as I've stated before in the show, one of the safest is Treasury bills or Treasury notes. So if there is a flight to safety, so if you see a lot of turmoil in the world, then that flight to safety will shift money into Treasury bills. Also, supply of T-bills by the U.S. government. For example, federal budget surpluses in 1998 to 2000 have reduced the supply of some Treasury securities. So supply and demand will affect the rates. Okay, so you'll have to look at how much is available. Okay, the third bullet point that they quote is economic conditions may influence rates. For example, uh, uh, 1994 notes that T-bill rates typically rise during periods of business expansion and fall during recession. So when you hear of talks of recession in the marketplace, this may be an indication that the Treasury bill rate will start to go down, which will mean mortgage rates will start to go down too. So talk of recession, even though it's bad news for the economy, is good news for mortgage interest rates because it's good news for rates for T-bills. Okay, monetary policy. Actions by the Federal Reserve. Fed actions that affect the federal funds rate likely will influence interest rates for other close substitutes, including short-term Treasury bills. So, the short-term interest rates or invariable rates or 5-year products or short-term borrowing rates, when the Fed drops its rate, it's going to affect the short-term borrowing on mortgages, right? So if you have a 5-1 ARM or something like that, you'll see those rates come down with a Fed, but not your 30-year fixed or your 15-year fixed. So Marco says I have a minute, which probably means I have 30 seconds. When we get back from the break, we're going to talk about the last bullet point that the Federal Reserve talks about, what influences Treasury bills and their rates. And remember, the T-bill rate is tied to mortgage interest. So if you know why Treasury bills go up or down, you're going to know why mortgages are going to go up and down, right? So this information is very useful because you can be ahead of the curve in seeking to either buy at a lower rate or finance at a lower rate before the masses find out based on news articles or the media pushing the information out. If you understand these correlations, you can get ahead of everyone else and beat people to the punch for refinancing or buying and locking in rates before the general public or the rest of the herd finds out. So when we get back from our break, we're going to get into the fifth bullet point. So I'll see you in a minute. All right, we're almost through this thing. I've had average 6 to 3 live viewers, so I appreciate your dedication all the way through this show, and I hope you have found it informative. Okay, so in keeping with flying out of here in the last 5 minutes, we're just going to get this thing kicked back up. Here we go. Welcome back to the show, everybody. I hope you've enjoyed today's show as we talk about the Federal Reserve lowering rates and then finding out how bonds affect mortgage interest rates. Also, knowing, that the Federal Reserve dropping rates does not have a one on one correlation with mortgage rates dropping. The Fed lowering rates, again, does not have a one on one correlation between 30-year or 15-year rates coming down. What affects rates coming down on 15-year or 30-year mortgage interest rates are the Treasury Notes, because banks have their interest rates for borrowing on a mortgage a few points higher than the rate of return on a Treasury note. So we've been going through what affects the T bills as far as their rates going up and down. And I pulled from the Federal Reserve of San Francisco their indication to the public as to what affects Treasury bill interest rates in general. And we went through demand, supply, economic conditions, and monetary policy. The last bullet point is inflation. Inflation and inflation expectations are also factors in determining interest rates. For example, periods of relatively high slash low rates of inflation usually are associated with relatively high or low interest rates on T bills. So if you have high inflation, you're going to have high rates on Treasury bills. And if you have low inflation, you're going to have low rates on Treasury bills. So keeping inflation in check is very good for the economy. When we have low inflation, that's good for everybody as far as being able to have purchasing power, and it's also good for keeping Treasury bill rates low, which also correlates to having low mortgage interest rates. So rooting for the economy to have low inflation is a very good thing and great monetary policy, because it's going to help us. It'll help you be able to refinance and keep those rates low for purchasing power in the market. So that's it. That's everything that I have as far as how bonds affect the mortgage interest rate. The most stable bonds are Treasury bills, and banks tie their mortgage interest rates to T bills. So the Federal Reserve is not tied to long term T bill interest rates. It's tied to short term borrowing. And the short term borrowing from the Fed rate is for banks lending money to and from each other, and for businesses to borrow to keep liquidity in the market and to stay afloat when times get tough, and to keep money in the system and the economy. So that's it. Thank you guys for joining me on today's show. I think probably next week we'll delve into some practical implications of what's going on with this flu that's going on and shelter in place, as far as how it's affecting current real estate transactions that are happening right now, from people wanting to either pull their houses off the market temporarily until the shelter in place order is lifted, how that's going to affect days on market from the multiple listing service, types of addendums that have been created recently to deal with delays in financing and delays of closing escrow, and other just practical day-to-day issues as far as being able to have open houses and whether you're allowed to have open houses with this shelter in place order, or whether you're allowed to even go out and show property right now. There's just a lot of things that have completely changed overnight that we're getting our arms wrapped around. So stay tuned. If you have any questions that are hot that you want to ask right now, let me know, and I can answer them for you. Info at realestateconnectionradio.com. Info at realestateconnectionradio.com. I'd be happy to give you some answers. Other than that, thank you for joining me on today's show. I appreciate your support. Uh, Enjoy this time that we have right now with your family. God bless you. God bless the state of California. Stay healthy, stay safe, stay strong. Pray for each other. And I will see you guys next week. And I am out. God bless. All right. Thank you, sir. I appreciate it. Stay safe out there. Marco, my producer. I'm going to hang up with you. And thanks for doing this remotely. I appreciate it. All right. You too. Take care. Bye bye. All right, so I'm going to stay live here for a few seconds. Does anyone have any questions out there as far as the practicality of what's going on in the real estate market, as far as how we're dealing with the shelter in place orders in Northern California? Whether or not you have a question about if you have a house listed for sale, or you're thinking about listing a house soon, or if you're getting ready to buy. I know that there's been I don't think we're at a place where we can actually go out and show homes right now, because of the shelter in place order, and I do not think that we're allowed to have open houses right now because we're not essential services. But double check by reading the county order. I believe the order has been duplicated for all the counties that have put it into effect. When it first came out, it actually had another county's name on it when Santa Clara County put their shelter in place order out. And as I believe I've read San Benito's county, as I have people down in San Benito that I deal with in business, I believe they just did a copy paste and then put San Benito County in as well. Essential services do include banking and moving money around, and also delivery. We're trying to figure out whether or not moving services are part of that. I believe we're aware that delivery services, as far as delivering goods, are part of that to keep the flow of supply in the stores um, are out there. So, seeing that we don't have any questions, go out there, read the order. If you have any specific questions, I am hunkering down here in my house, sheltering in place with my wife, and spending some quality time. So get on the phone, call your friends and neighbors, enjoy those home cooked meals or that takeout. Who would have thought that DoorDash would be the business to be in, especially in this next couple of weeks, right? It's going to be pretty amazing. Amazing times we're living through. Stories that we're going to be able to tell our children, our grandchildren, and our children's children. So that's it. Thanks for joining me. Share, share, share. And I appreciate all of your fantastic support out there. And if you have any questions, feel free to email me at info@realestateconnectionradio.com. And like and subscribe, you YouTube watchers out there. And this will become a podcast, and you can find me on podcasts on iTunes under the Real Estate Connection. Once the show has been produced by the radio studio and I get a copy of it. Thanks for joining me, you guys, today. And be safe, be healthy, take care, and I'll see you later. All right, I'm out.